So cup and handle patterns are continuation patterns. They're big ones. So I think gold's going to continue higher. If interest rates continue to go up, I think people are going to continue to sell bonds. I think they are going to eventually, if interest rates get to a certain spot, which I think we're close to, we could start to see interest rates have an impact on the overall stock market too, financial assets. So I think gold's going to continue to go up if we get an increasing interest rate environment.
You're watching Capital Cosm. My name is Danny. It is June 3rd, 2025, and my guest today is Andy from Finding Value. Thank you so much for coming back on the show, my friend.
Yeah, thanks for having me on. Really appreciate it.
Definitely. It's always a pleasure having you on, Andy. Let's just dive right in. For you right now, what is occupying your headspace? What do you think is most topical for the average investor out there?
Yeah, well, number one, I'm kind of bullish on all commodities just in general, energy, fertilizers. I mean, just everything in general. But things that look the best at the moment, I still think gold looks good. I still think silver looks very, very interesting at this area that we're at. And then I think a lot of other commodity sectors are all kind of starting to bottom out and are starting to try to turn. So if I were to say, what's in flavor right now, I would say gold looks good. That's had a really, really big run. I think silver's next in line. And then the rest of the commodities I think they're going to follow here at some point over the next, say, 6 months or so.
Do you have any charts
So that's kind of,
do you have any charts we can look at to kind of get your take on the precious metals? Let's start off with the precious metals, gold being foremost. Where do you see the price moving from here, given some of the recent price action?
Sure. We can share my screen real quick.
Sure.
Yeah. So the first thing that I kind of view everything, I go, when I look at charts, I look at things from a long-term perspective, and then I dive in and kind of try to look at it from big view, and then just keep diving into smaller and smaller time frames.
Mm-hmm.
When I look at silver, again, this thing's been bullish for a pretty long time. I think that this is just a big cup and handle pattern, and I'm sure everybody's kind of worn out about hearing the cup and handle pattern on silver because everyone's talking about it.
Mm-hmm.
But there's the cup and handle on the big long-term view. If we kind of dive into the right-hand side of this pattern here, we get a little bit of resistance basically right where we're at, right around $35-ish. So we're coming up into a little bit of resistance. We could pause here for a little bit. I'm not saying that we will 100% pause for any length of time. No one knows that with certainty. But when I look at the 35 area, it's like, all right, we're going to bust through this probably any time, and then I think we'll get a nice good move higher after we break through 35. The way that I view this, and it might be different than a lot of other people, I think that I'm just going to pull up the 10-year yield. Actually, you know what? I'm going to pull up the long-term silver chart and put the 10-year yield underneath it. And the way that I view these markets here is I'm of the camp that yields are driving a rotation of money, and then these big downtrend lines that are broken push silver higher. Money rotates out of bonds, it rotates out of financial assets and seeks alternative investments. So this was the downward move back in the 1900s of silver.
Wow.
It was a falling wedge that turned into a double bottom, which is, it's just a pattern repeats over and over throughout history. Interest rates start to move on up, and then people start to buy silver until interest rates basically turn. Then you get another falling wedge into a double bottom. It's the pattern repeating again. We had another move up in silver during a decline of interest rates. But what we're seeing there is that the decline of interest rates, which was from this point here
Hmm.
to this point about here, this is the cup and handle. So the cup and handle, the consolidation occurred in the declining interest rate environment. The consolidation occurred in the declining interest rate environment. And this move higher was part of the consolidation in 2000 to 2011. So when I view this, and I know a lot of people are only looking at the technical charts, I try to look at like what's driving the charts. What are driving people to move money from one asset to another asset? And with silver here and the interest rates breaking out of the 40-year downtrend, I think this is it's going to go into what I'll call launch mode, where because the drivers are all in place for this to go up, because we're coming out of that consolidation of this pattern, I think that whatever we project up is probably most likely going to occur. So if we were to project this up higher, I think it's totally possible that we get to a $350 an ounce target over. It's not going to get there immediately, and that's where people get all kind of confused. They think just because something could go that high that it's going to just go straight up in like a year. That's not how it's going to work. This is going to occur over a longer period of time, 10, 20, 30 years. And 350 is just what the projection is. It doesn't mean that that's where it will stop.
So how'd you get that
So
projection, Andy?
yeah, I grabbed this projection. It's the size of basically the cup
Okay.
projected on top of the pattern. So it's this cup pattern size. So it's the top 50-ish dollars is roughly the top. And then we get the bottom down here in 2000 or 92 and 2001 or so. And
Hmm.
that projection you put on top of the pattern and it projects up to about 350-ish dollars. I wouldn't, a lot of people, they put a lot of weight on the price projection. I don't think that's like, I don't put much weight on it. What I look at is the size of the pattern. It's gigantic. It's also big in length. So this is going to take some time, the time length. So I think it's going to take some time. We could get a big move, say from $35. We're probably going to move upward in like waves almost. So we'll probably like bust out like this and then come back on top of the pattern again and then move on up after it. So I think that's what's going to occur. And again, this is all just me speculating. But what gives me comfort is that the conditions that silver went up in before are present today, which is an increasing interest rate environment. And that's what I focus on are the conditions that are being subjected to the herd of humans trading in those conditions, and they behave a certain way under those conditions. So the patterns and the technicals are just an extension of the psychology of the herd, and the herd is just behaving on the conditions that are being subjected to them. So the conditions are all present for this to occur, and silver is cheap against financial assets. It's pretty much a slam dunk where you've got all the conditions that are present for this to occur, if that makes sense.
And those conditions are rising interest rate. Is that the only thing, or is there anything else?
Yeah, so you've got a rising interest rate environment. You've got hard assets that are cheap to financial assets, which is a very big deal in my book. So think commodities or precious metals priced in the S&P 500, priced in the Nasdaq, priced in bonds or whatnot. So I think that's another anchor of information there. There's also other things that could influence this, the real estate cycle, and then there's longer term cycles that are also overlaid on top of that. Some people call it the K wave. Um, I'm not as well versed in the Kondratiev wave. They say it started in 2000 and is moving on forward. The real estate cycle, which is overlaid on top of this, that's what drove commodity bull markets historically, a lot of it, because that's what created the money and the increased money supply coming into the system. So when money comes into the system, it creates inflation. Inflation pulls interest rates on up, and then money starts to move differently in the markets as that money and inflation comes through the system and interest rates start to move on up. So money kind of shifts. We're in an expansion phase of real estate at this time. And I know there's a lot of people that are debating if we are going to get a slowdown in the housing market or not right now. But right now, we're in an expansion phase. We're above the average home builds of about 1.2, 1.1, somewhere in there. And we're above that. So we are in an expansion phase by definition. So all those are overlaid on top.
And that's because we're entering into the, oh, is there feedback? Okay. Is that because we're entering into the millennials home buying years? Is that what's going on with real estate? Is it because millennials are being able to buy homes, or not being able? I mean, I'm a millennial. You're probably the oldest millennial, I believe. But yeah, is that the reason?
Yeah. So when people came back from World War II, we created a large boom, basically in America, the baby boomers. And the baby boomers went into home buying years in the 1970s. So from 1970 to, I'd say, early 80s, we had a big, huge demographic bulge coming through buying homes. And they had a bunch of kids. So when they had those kids, they were the millennials. And that's us for the most part. A lot of us are baby boomer, have baby boomer parents. So we're coming to the home buying years. We're buying homes, and before the millennials, we had a crash in the real estate market. That was the mid to late 2000s, and that crash created an underbuilt condition where new home builders couldn't compete with foreclosures, so they underbuilt for many years. So as the millennial demographic came in, we have increasing family formations. People are wanting to buy more homes. We've underbuilt from the previous housing real estate crash and all the foreclosures that were competing with new home builds, and new home builds were incredibly low for a long period of time. So we are underbuilt in relationship to new family formations by many millions of homes. So that's kind of where we're at.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pinbeck. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pinbeck a call. They'll help explain the process and get you started on the right path. Your support at Pinbeck also helps support the channel. So reach out to Pinbeck today. You won't be disappointed. And make sure to tell them Danny sent you.
As homes are built, they get new loans put against them. So you've got two forces that create inflation. You've got fiscal spending, which is the government spending, and then you've got monetary bank lending. Monetary bank lending explodes higher under these expansion booms because as new homes come in, they generally get loans against them. So as more loans get put against new homes, that is inflationary because it's a new loan against a new house and it comes into the system. Right now, they've kind of slowed down that lending process. Interest rates, they yanked interest rates up, and they've really slowed down the monetary bank lending side, and the fiscal side keeps pumping. So that's kind of the conditions that we're in right now. Historically, it was more monetary driven. Now it's being more fiscally driven. Looking at history.
Understood. Touch on gold here for a bit because we kind of jumped right into silver. What's your view on gold at the moment?
Yeah, so my view is the same exact view with gold as it is with silver, except gold is a little bit more sensitive and front runs things.
Hmm.
So gold was held down during this time frame. It was basically fixed at a certain price. So as interest rates started to go up, you can't see it in the same um, light as say silver because silver was freely traded. So it was suppressed here. Gold was as interest rates started to move higher, and then I think the market and government said, you know what? I think you're cheating the system. I think you're printing too much money back here. So we want to exchange our money for gold. And they started to exchange currency for gold. And eventually the America said, like, time out. We know we cheated. Like, they know what they're doing. So they said, we're going to close the convertibility of dollars into gold. Gold was freely traded, so you could see the big move higher in gold there during that time frame. On top of it, it was a very inflationary period. Interest rates were moving higher. Bank lending was booming. It was the baby boomers buying all those homes. So I think it was a combination of money coming into the system, interest rates already moving on up, and then gold revaluing itself back again. So I think that we got the same conditions occurring. We have the nice cup and handle. If I were to throw this here, this is another cup and handle there that's broken to the upside as interest rates continue to go on up. So, and this is kind of the lead-in pattern of that big move. So we kind of came up, cup and handle, and then we're breaking higher again. So cup and handle patterns are continuation patterns. They're big ones. So I think gold's going to continue higher. If interest rates continue to go up, I think people are going to continue to sell bonds. I think they are going to eventually, if interest rates get to a certain spot, which I think we're close to, we could start to see interest rates have an impact on the overall stock market too, financial assets. So I think gold's going to continue to go up if we get an increasing interest rate environment, and then it'll be it'll be like the new bonds.
Right, and you mentioned the silver cup and handle pattern, but as we can see here, gold also is lifting off from a smaller cup and handle pattern, one that traces
Yes.
its origin back to 2011. And you can see last year we just broke out of it. And then if you look at some recent price action, if you kind of convert it to the candlesticks and go to the daily candlesticks, you'll notice that we're kind of seeing a similar cup and handle pattern play out here. Well, not here, but kind of like the same consolidation pattern that we saw right after, I want to say 2020. So between 2020 to 2024.
Yeah, right here.
Mm-hmm. So
Yeah, it's the
it kind of
same
looks like a
fractal
fractal. Yep.
pattern. The way that I view this is I just throw a line kind of on top of it, like this, and then I just copy it, and it's basically a big flag pattern. Is the way
Mm.
that I kind of view it. And yeah, I think it's just a continuation pattern to go up.
Yeah. So it's
So yeah, everything looks good. A lot of people are going to try to predict these short-term price movements, and I just don't think that's. I don't think that's where you want to be. I think you want to look at this from a long-term perspective. If you've got patterns that are facing downward, so I mean, you can try to do like this, or you can grab it if the bottoms are coming up like that. And I'm not so much fixated on the pattern itself. It's it doesn't kind of matter. It doesn't matter what the pattern and how clean and clear it looks. A lot of people worry about hitting certain lines or certain dots. I'm not really like that. I kind of just look at things and it's like, is this downward facing, and draw the line real quick. And if the pattern is facing kind of downward, you're good to go higher.
yeah.
If the pattern's pulling back and you've got like a slight angling downward, it's good to go up. We don't want to create patterns that are upward facing, like rising wedges, or increasing flag patterns. Because usually you're coming down, you create that pattern as you move lower.
Right.
So right now, everything that I can see in this chart is bullish. The longer term, bigger picture view, the cup and handle pattern that's broken to the upside, that's bullish on a long term perspective. You jump into the short term, you've got all downward facing kind of patterns that are being created. It's all bullish. So we're going to continue to stair. I call it a stair stepping process where you kind of stair step on these steps there as we continue to move on up. So
Andy,
I think everything looks bullish. We can also look at other metrics around gold. You could do like a gold to M2 money supply. You could do
mm,
gold to S&P 500. So if we were to throw like an S&P 500 on the back of this, and then we just kind of zoom way out. So I had it on logarithmic, but I think that we're kind of squeezing into this corner over a very long time frame, and eventually this will break out of this. So one could state, and if you try to make sense of all this, that the Industrial Revolution kind of created a downward slant to gold and the production of goods and services around gold, and that's the S&P 500 is growing faster than gold. One could state that this is a falling wedge pattern with the 3-hump consolidation, perhaps, and that eventually will break out, signaling that resource constraints are greater than the productive capacity of, say, America. I mean, I'm just making this up as I go. It's not, this isn't a fact. I'm just trying to figure out, well, what could cause gold to permanently outperform the S&P 500? It could be, all I can think of is like resource constraints out in the future,
well, you're
because it's just a
already
falling
starting.
wedge.
Yeah, you're already starting to see gold outperform copper, which is a pretty damn good proxy for industry and the economy. So if you pull up the gold to copper ratio or copper to gold ratio, you can kind of see that play out now. And yeah, so there you go.
This is gold versus copper as it kind of works its way on up. But I also think that, I mean, copper is going to have, we're going to have problems in a lot of these different areas. So I think what the market's trying to price in is, it's not necessarily the economy. It's the economy versus the currency system. And our currency system has a certain design, and the design is we need to continue to print money for the currency to exist. And in order for the money to exist, the currency, you got to grow GDP along with it. If you can't grow GDP as fast as you grow currency, then you will get into a problem where people want to reject the currency. So it gets out of balance. You get too much inflation.
Hmm. And that's what we're
So
seeing now. Here's another
mhm,
couple of charts to pull up M2 money supply and M2 money velocity. And money supply is making all-time highs as we speak, and velocity is coming down despite more money supply being injected into the system. So I believe that's your ratio for GDP, right? Or is it the other way around?
yeah. So well, your GDP is M2 money supply times your M2 velocity. It's the
Hmm.
multiplication of both of
Right.
those. This is divided by.
Okay.
Um,
Gotcha.
we could do the multiplication, which is GDP. Um, it's those two. That's GDP.
Hmm.
But GDP is really just oil consumption.
Right.
So oil, whether oil is the driver of it, or oil is the number one commodity. So if you print money at a faster pace than oil's supply, we see these large inflationary periods. So 1970, when we had all that money coming into the system from the baby boomers that I talked about earlier, the bank lending, the baby boomers basically buying a bunch of homes. What it exposed is that it exposed a weakness in oil. We hit peak oil in 1970 for conventional in America, and we had this huge inflationary period. So we had a constraint in oil with more money coming into the system due to bank lending. That also occurred in the year 2000s when we hit conventional peak oil in the entire world. So in the 1970s, we were bailed out by growing into world production. World production was basically, I'll say, constrained in the mid 2000s. People were worrying about peak oil, and we drove oil prices on up as money was coming into the system. Bank lending, we had the big real estate boom, and it exposes weaknesses in the system that money coming into the system does, because it says turn on more production, give me more, whatever it is, commodities. What I fear is coming ahead of us is that we've got the system that needs to continually grow its debt exponentially, and it's going to hit a oil constraint, which most of the growth of oil recently has come from the United States shale. And if US shale production peaks, we're going to keep going up in money printing for the system to survive, because that's the way it's designed. And then you hit a constraint in world oil production, and I think you're going to see a massive inflationary problem if that were to occur the way that I'm describing it. Now, if we can somehow grow oil production out from somewhere else, somewhere else in the world that we haven't found yet, and that we've already scavenged around pretty well, we'll have to figure out, how to grow energy production from something other than, say, oil and maybe even natural gas and coal, which we'll see what happens. But I think we're going to hit a constraint here where, I'm sure everybody hears Lynn Alden, nothing stops this train from a fiscal perspective. They print, 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 print. They can't stop it. And then they hit a constraint in oil, and then it's just game over, because you can't grow your GDP with an oil constraint alongside the growth of your currency system. And that's fiscal spending. So if they raise interest rates, they kill monetary bank lending, which they've already done. But fiscal spending, the interest expense, blows out. So if they keep raising rates, you get more and more money dumping back in, coming into the system through interest expense. And that's kind of the end game. And then it says, feed me more oil, feed me more oil. And oil says, we're done. Like, we can't produce more oil. So that's what I kind of fear is coming out in the future. If that were to transpire that way, then physical metals will go vertical, because they'll look at the system. The entire system is being priced off future growth. Your bond market is, interest payments out in the future. Your stocks are all growth related. So their price to earnings ratio is earnings out in the future discounted back to today using kind of the 10-year yield through a net present value calculation. That means that all those models are wrong, because that means that we've got this infinite amount of energy out in the future. So I know I'm kind of going down this path, but I think that's kind of what the market is pricing in. And people will say, well, we'll just go to solar, we'll go to all these other ones. And I don't think we've got the resources to do it. Like, I don't think we physically have the silver. I don't know if we physically have the copper. Like, I don't know if we physically have all of these materials to go to a low energy return on energy investment and a low net energy return off of mineral requirements.
How
So
have we
energy
been
per
able to,
mineral requirement.
how have we been able to kick the can so far down the road for so long, given the fact that oil is still pretty cheap? Then you add on an inflation adjusted tool like gold, or you price oil in gold or whatever. Oil is even cheaper, and silver's still relatively cheap to gold. How have they been able to keep the price down despite the constraints?
Yeah, so we're looking at shale oil peaking here, like basically flatlining. And that's kind of what I'm projecting. So we've been going up in shale for a period of time. They increased interest rates quite rapidly in 2021 to kill bank lending. So you could see that house prices were and house sales were rapidly increasing in 2020 and 2021. They raised those rates on up, killed the affordability, and tamped everything down from bank lending. The problem is they tamped that down like the 1970s, so to speak. They're trying to hold the demographic down from
Mhm.
buying all these homes and letting bank lending increase the money supply. But the fiscal spend just keeps pumping. It's like stimulative in the background where they can't totally shut it off. So oil, we've had growth in oil, and that stimulus that they created, the lending that was being done in the 2020 2021 timeframe, that shot oil all the way up to 120. They tamped it down using interest rates. They killed the bank lending. They slowed that all down with higher interest rates, which created wave two, an Elliott wave. So wave one was the big move. Wave two is the pullback, and they've been holding that down. And more recently, we've got this tariff stuff and all this other things that I think they're trying to bring back production to America because they probably have figured out that maybe there's problems with oil or other things that we should probably be producing things in our own country versus being reliant on other things. So I think it's all interconnected. I think that tariffs are interconnected with the debt, which is interconnected with energy constraints, which is all kind of it's all meshed together in the current market conditions that we're living in. So oil is cheap. It came on pretty heavy in 2014. Shale oil, that's where 95% of the growth came from. We ramped it on up. If they didn't do those interest rates and ramped them way up, I think oil would have been just ripping. So they held it all down through increasing interest rates dramatically. Now, oil's on the cheap side. It's very cheap right now, but I don't think any of the problems have been fixed. It's all been demand slowdown with interest rates.
I
Is how they
see.
kind of controlled it.
So to kind of cap things off, bullish gold, bullish silver, bullish oil, bullish commodities in general.
I'm bullish. Natural gas. Natural gas
Natural
looks
gas.
ridiculous. We have LNG takeaway capacity coming. It's a gigantic wall. I'm not even sure how they're going to fulfill it. Like, I mean, it's coming. You've got artificial intelligence. If the tariffs, I'm just going to do an if the tariffs are successful, well, what does that mean? It means more energy demand in America if we're going to start to build all these things back in America. If it's steel, aluminum, if it's new manufacturing facilities, we got to build all this stuff. We got to get energy inputs to all this. It's all energy demand. As we progress, and if we are going to go away from oil, we're going to have to mine far less ore grades. So ore grades are declining for copper, and we have to go to smaller deposits that are more scarce in the world. And then we're going to have to mine less ore grades, which means you're going to have to dump a whole bunch more energy to get it. So copper is just the conversion of energy moving earth and then refining it to copper. So it's more or less just the conversion of energy of moving earth around, so to speak, and getting copper in return. Lower ore grades means you just use more energy, unless you can figure out a way to extract it far more efficiently than what we currently are. But the way that I kind of view the future is demand is dollars. I don't look at it like human beings necessarily. It's more currency. So as currency comes into the system, whether it's fiscal or monetary, that is demand for whatever it is. It could be demand for copper, demand for energy, demand for whatever. That puts demand in the system, and then we're going to have to yank this stuff out. If there's constraints in the system, which there is, I think we're just going to run the price of all this stuff up. Or conversely, it's the value of the dollar going down, if that makes sense. So demand is dollars or credit in the system, and then constraints.
Are stocks safe in this environment?
No, I don't think regular companies are all that safe because
Well, what about mining stocks and energy stocks?
oh yeah. So energy, anything that the problem is going to come about in. So I think there's going to be constraints in energy, constraints in mining, but I'd rather choose energy because you're playing the margins in the companies. You're not playing the commodity itself. So if you're buying an equity, an energy equity, or a steel company, or a mining company of gold, you're not playing the gold price. You're playing the margin. So if you've got the margins in a gold company, and let's say you hit an energy constraint, let's say shale oil's peaking, demand continues to go up, and they're like, okay, well, where are we going to get all this oil? We need to bring oil prices back up. Oil goes to 60, 70, 80, 90, 100, 110, 120, 130, 140, 150. It just keeps going, and we don't get the supply response. Maybe we do, maybe we don't. We'll have to see. The margins for those companies, if oil is going up faster than, say, gold, are going to shrink. So right now, they're real big. So I think mining companies are going to do incredibly well in the short term here. But I'd be watching what oil price does, because if oil starts to heat up again, the margins might start to compress again. That's exactly what happened the last bull market in the 2000s. In the 1970s, I don't think gold stocks did all that well for the entire bull market. There were periods that it did well, but they didn't do as well as, say, something like an energy service company or an energy company. So, but the metals did incredibly. The physical metals did. So the way that I kind of view this is the physical metals, I think, are the least risk way to play all this, and then the energy companies and a lot of the companies that provide energy I think are pretty solid.
Understood.
But yeah,
Andy, thank you so much for coming on, my friend. It's been a pleasure having you on. Where can people find you if they want to see more of your work?
Yeah, you can check me out on YouTube. It's findingvalue.com, or sorry, Finding Value Finance on YouTube. Finding-value.com for the website. If you guys want to see what I am buying and what I'm doing, so you can follow me directly on that. We have a coupon code special that's still active if you'd like to join and get a discount.
Okay, we'll have the links to your YouTube, your X, as well as your website down below. So check them all out, guys. If you're interested, guys, drop us a comment. Go, Andy, go in the comments section. If you agreed with Andy's analysis, if you disagreed with anything, that's fine too. But let me know what you disagreed on. I do, in fact, read the comments. Hit us a thumbs up, like the video, subscribe to the channel, do all the YouTube stuff, because it certainly does help us in the algorithms. Let's get this video boosted, and let's get this channel shared with as many people as possible and get people informed as to what's coming down the pike. Every little bit helps, and I deeply appreciate it. Check me out on Substack as well at capitalcosm.substack.com to get early access, ad-free versions, and uncensored versions of all my videos for the ones that warrant it. Andy, you're a good boy today. I didn't have to censor anything. So, nothing Substack exclusive on this front for today. But thank you guys for watching. I'll catch you later. Bye.